Let's talk about finance. First of all, what is finance? Finance is a term broadly describing the study and system of money, investments, and other financial instruments. Some authorities prefer to divide finance into three distinct categories, like public finance, corporate finance, and personal finance. Other categories include the recently emerging area of social finance and behavioral finance, which seeks to identify the cognitive reasons behind financial decisions. Now, let's talk about the basics of finance. Finance, as a distinct branch of theory and practice from economics, arose in the 1940s and 1950s with the works of Markowitz, Chobin, Sharpe, Traynor, Black, and Scholes. To name just a few, of course, topics of finance such as money, banking, lending, and investing had been around since the dawn of human history in some form or another. Finance have three roles, and the first role is capital budgeting. Capital budgeting is the process that a business uses to determine which proposed fixed asset purchases it should accept and which should be declined. This process is used to create a quantitative view of each proposed fixed asset investment, thereby giving a rational basis for making a judgment. Second role is the capital structure. The capital structure is the particular combination of debt and equity used by a company to finance its overall operations and growth. Debt comes in the form of bond issues or loans, while equity may come in the form of common stock, preferred stock, or retained earnings. Short-term debt, such as working capital requirements, is also considered to be part of the capital structure. And the third role is the working capital. The working capital is the capital of a business which is used in its day-to-day trading operations, calculated as the current assets minus the current liabilities. There are two ways to analyze a financial statement analysis. And first is the horizontal analysis. It is used in financial statement analysis to compare historical data such as ratios or line items over a number of accounting periods. Horizontal analysis can either use absolute comparisons or percentage comparisons, where the number in each succeeding period are expressed as a percentage of the amount in the baseline year, with the baseline amount being listed as 100%. This is also known as base year analysis. The second analysis is the vertical analysis. Vertical analysis is a method of financial statement analysis in which each line item is listed as a percentage of a base figure within the statement. Thus, line items on an income statement can be stated as a percentage of gross sales, while line items on a balance sheet can be stated as a percentage of total assets or liabilities. And vertical analysis of a cash flow statement shows each cash inflow or outflow as a percentage of the total cash flow inflows. Financial ratios. Financial ratios are relationships determined from a company's financial information and used for comparison purposes. Examples include such as often referred to measures as return on investment, return on assets, and debt to equity, to name just three. These ratios are the result of dividing one account balance or financial measurement with another. Usually, these measurements or account balances are found on one of the company's financial statements, like balance sheet, income statement, cash flow statement, and or statement of changes in owner's equity. Financial ratios can provide small businesses, owners, and managers with a valuable tool in which to measure their progress against predetermined internal goals, a certain competitor, or the overall industry. In addition, tracking various ratios over time is a powerful means of identifying trends in their early stages. Ratios are also used by bankers, investors, and business analysts to assess a company's financial status. Ratios are calculated by dividing one number by another. total sales divided by number of employees. For example, ratios enable business owners to examine the relationships between items and measure that relationship. They are simple to calculate, easy to use, and provide business owners with insight into what is happening with their business. Insights that are not always apparent upon review of the financial statements alone. Ratios are weights to judgment and cannot take the place of experience, but experience with reading and tracking them over time will make any manager a better manager. Ratios can help to pinpoint areas that need attention before the looming problem within the area is easily visible. There are three types of financial analysis, and the first type is current ratio. The current ratio is the liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. It tells investors and analysts how a company can maximize the current assets on its balance sheet to satisfy its current debt and another payables. Second is the quick ratio. The quick ratio is a more conservative version of another well-known liquidity metric, the current ratio. Although the two are similar, the quick ratio provides a more rigorous assessment of a company's ability to pay its current liabilities. It does this by eliminating all but the most liquid of current assets from consideration. Inventory is the most notable exclusion because it is not as rapidly convertible to cash and is often sold on credit. Some analysts include inventory in the ratio, though if it is more liquid than certain receivables. The last one is the working capital. Working capital is also known as net working capital. It's the difference between a company's current asset, such as cash, accounts receivable, customers, unpaid bills, and inventories of raw materials and finished goods. Net operating working capital is a measure of a company's liquidity and refers to the difference between operating current assets and operating current liabilities. In many cases, these calculations are the same and are derived from company cash plus accounts receivable plus inventories, less accounts payable and less accrued expenses. Working capital is a measure of company's liquidity, operational efficiency, and its short-term financial health. In a company has substantial positive working capital, then it should have the potential to invest and grow. If a company's current assets do not exceed its current liabilities, then it may have trouble growing or paying back creditors or even go bankrupt. Inventory turnover. Inventory turnover is a ratio showing how many times a company has sold and replaced inventory during a given period. A company can then divide the days in the period by the inventory turnover formula to calculate the days it takes to sell the inventory on hand. Calculating inventory turnover can help businesses make better decisions on pricing, manufacturing, marketing, and purchasing new inventory. Next is accounts receivable turnover. It is a efficiency ratio or activity ratio that measures how many times a business can turn its accounts receivable into cash during a period. In other words, the accounts receivable turnover ratio measures how many times a business can collect its average accounts receivable during the year. Next is fixed asset turnover. The fixed asset turnover ratio is in general used by analysis to measure operating performance. This efficiency ratio compares net sales to fixed assets and measures a company's ability to generate net sales from its fixed asset investments, namely property, plant, and equipment. The fixed asset balance is used as a net of accumulated depreciation. A higher fixed asset turnover ratio indicates that a company has effectively used investments in fixed assets to generate sales. From ABM to Pipe, thank you for watching.